So, going on overall to just kind of working on Bitget, the reason I use this thing is mostly because, yeah, I'm in Sweden. You can it'll suggest changing the language for me and all that and whatnot. The reality is they are going to be restricted for some places, probably the US and the UK, but a simple VPN can get around those things, especially with most exchanges not being, built inside of a very regulated country, if at all. So my argument is very simple when it comes to exchanges: spread your risk. No exchange is going to be perfect. Binance has had a lot of FUD hitting it right now, if you haven't already noticed. I've probably pulled quite a bit of funds from there just as like a stopgap. Plus, I don't really use it much anymore. The big thing being is that if you have assets in crypto on exchanges, you need to understand that it's not your crypto. The term, the phrase, not your keys, not your crypto, that is, the words you live and die by if you're trading, because everything needs to be able to be pulled as quickly as possible off those exchanges onto your wallet. So if you ever do get a different exchange, like testing Bitget or trying it, my first recommendation for people when they get new exchanges is make sure that before they put any money on it, is that they set up off ramps. They whitelist a couple addresses where they can, one click, bang, eject me from the exchange as quickly as possible. So that's something that I do just to protect myself, just because I don't trust anyone when it comes to exchanges. I simply don't. Going with that, I think I loaded this thing, it was like $250 or something like that. I don't have a KYC requirement because it's not massive. And the markets that we can look at, yeah, you can buy all the different types of crypto. If you're just buying, loading it up with money exchange. The best thing is if you want to be anonymous, there are a couple things you can use to load real fiat money into crypto without actually having to use your card to an exchange. There's a lot of different ways to do it. There's the peer-to-peer network type stuff, which is cool. But overall, I would mostly recommend using exchanges for trading futures if that's your purview and what you're capable of doing. I do have a bunch of different stuff like copy trading and different bots and stuff, which is, I guess, cool. I don't really trust any of this stuff. And mostly it's because all exchanges use a difference between, the mark and market price, or they'll call it the mark and the index price. And I'll go through that here now. So with the markets, I'll just click on futures. You can use USDC, USDT, or the actual coin. The biggest difference between, of course, we almost always use USDT. That way you're not allocated to that asset. Once the bull market starts, I'll probably be using coin for a lot of my Bitcoin future stuff, where I'll be using Bitcoin as the underlying asset to trade long on Bitcoin futures. So I'm winning double, right? My bigger trades, my higher time frame trades, I can use that coin to then take larger positions on my existing coin. And that's essentially, I'm maximizing my gains overall, but I'm still always really, skeptical as far as like holding massive amounts of, my wallet and stuff on a single exchange. So, but that's not something for the bear market. A lot of people I saw at the beginning of the downside back at the end of, 2021, a lot of people were like just starting to flip short and use Bitcoin to short Bitcoin, which I thought was just one of the most bizarre things in the world to me. Instead of like, why aren't you just, if you DCA in and invest in Bitcoin, you should DCA out of it and sell it out on the way down. And then take short positions with an asset that's not going to devalue massively. Okay, yeah, US dollars devalues quite by a large percent over the last couple of years. But overall, it's not like what Bitcoin did by going, over half off the all-time high still. So just looking at this, I think I have Tether loaded on this thing. So I'll look at the Bitcoin USDT and kind of go through the exchange use primarily. And then from that exchange use, we can then go through a couple more advanced stuff with the different types of orders using trailing stop, trigger and post only and whatnot, and the importance of using those. And with that, when I'm looking at the drop down, they use something called trigger. If you have another exchange, it might also be called a stop limit or a stop market order. Essentially, I'll go into that. You're just using that as like a requirement to execute an order by price hitting a certain price, I guess. So overall, just on Bitcoin USDT, the big thing that you got to remember in all exchanges, there is a difference between the mark price, which is what the price is on that exchange, and that is the price you will be judged on. If you get liquidated, it's because the mark price hit your liquidation. If you take profit, it's because you're on the mark price. Yes, with this, it gives you the opportunity to change it based off market price to mark price, but I would recommend using mark because that's what you're going to be judged by on your stop losses, and that's what the exchange is running off of. So think of exchanges as having their own internal price, all trying to find the index. And because, as an example, the mark price is below the index price, it's going to affect things like funding rates. And I'll go through funding rates in a second too. So remember, mark price, this is essentially what you're going to, improve the stability, blah, 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 abnormal market conditions. Reality is that's what you're judged by. That's the important thing to remember, is that that's the internal price of the exchange itself. So with that, looking at funding rates, the most important thing about funding rates is that the majority of exchanges, I know FTX didn't, they had a rolling funding price where it would change pretty dramatically. But every 8 hours, you're going to get updates on your fees. And the way to understand fees is, as an example, if I am taking a long position, because the fee is positive, I will have to pay that amount in a funding rate, or if I'm using leverage, that percentage of my trade value is what I'm paying in that time period. And the reason for that is because they want to incentivize liquidity providers and market makers to provide liquidity, and they're incentivizing them by their funding rate. So in this instance, longs are paying shorts because so it's going to cost longs to take positions. If the interest rate is negative, into a short position, that will tell you stuff like that big people are trying to short at certain levels or at certain prices. At the end of the day, the difference between market price or maker and taker price is usually about a 3x. Now, with Bitget, you can go on their documentation and you can see what the average maker taker fee is. It should still be 0.02 and 0.06. And what that means is if you're taking a position on futures, you're going to be paying, let's say you take a limit order, right? A limit order, you're going to be taking about a third the size. It's going to cost you a certain amount of like a 0.02% on the size of on the value of your trade is what you have to pay as far as a fee, right? Or maker fee or taker fee. And that's if you're making, like you're adding liquidity to the books. So that means if you set a price to say, well, I don't want to take a position unless price hits, let's say, what are we at now? I don't want to take a long until we hit 25,662. So I just take the price. I say what I want to take it as 25,662. Let's say I want to risk, what is that? 0.03 Bitcoin. And I'll buy long, open a position at that price, right? So when you're actually looking at this stuff, the biggest thing to remember, and it's getting me a little bit disconnected. I've got bad weather where I am, so hopefully won't mess it up. It's not super important, but the big thing going into actually taking that position, that's the difference between maker and taker. If you're taking limit positions, you are adding liquidity to the books as long as your positions, let's say, since I'm trying to take a long, right? That's essentially saying I want to take a long at this price because it's below the current price. If you take a long and you hit enter that at the current price or a higher price, it will automatically market enter you into that position. So you think you're saving money on fees, you're not if you're trying to pick a price higher. And there's a couple ways around that, and I'll show you that. It's pretty cool. So if you're looking at that as far as like a maker taker, it's essentially if you're marketing in and out of a position, if you just select the market, the hardest thing about it is that you're now paying 3 times the fees. If you're trading with large order sizes, it needs to be something that you take into consideration because it's extremely valuable overall. And let me just check. Yep, open order was entered. That's the price. No stop loss set. And it's unexecuted because it's now existing. That's my open position to take a long, essentially, as an example. If you mark it in and out, right? If I just cancel that order real quick, and let's say I want to mark it in at 0.03, and I hit the buy button, 3% of the quantity, 3% of the account size or whatever, and I buy the long, you'll instantly be entered into a position. And again, you're paying 3 times the fees. So we'll go over a couple different things with that as well. You'll have important information. You have your return on equity. You have your margin ratio. So what part of your position is going to be essentially allocated. Once that margin ratio hits 100%, that means you will be liquidated. And usually you'll have that information here of like where's the what my margin rate is locally. Sorry, that's the margin ratio. Margin rate, that's what you don't want to hit 100% on because that's my liquidation price, 25,531. That will liquidate the current position. The position size is, let's see, it's 2.6 margins, absolutely nothing. And that's how much it would close for. So the max it would be closable for. So with that, there's a couple things we can use to do. You can close, that just closes the position. If you hit a reversal, that will be essentially close at the market price and open in the reverse for the same amount. That can be useful if you're trying to scalp stuff locally in lower time frame. You see a reversal, you're now, let's say you take the trade down here at 25,638. You see the top coming in, and you want to reverse it really quick. It's a really great function. It is a market order, but again, if you're scalping on lower time frames, most of the trades you'll have to be doing on lower time frames are market entries. Going on to some more interesting stuff, trailing stop as an example. We'll do that first. So let's say if you're already in a position, and this is an important thing here, obviously the open position versus closed position. If you want to close your position, that means that the only thing that can be done, essentially, let's say if I switch up the market, and let's say I want to close a certain quantity of the trade that I'm already in. So if I'm in a long, and I want to close, because I'm on Bitcoin USDT, right? And let's say I want to close half of my account and just market close it. I can close half that long just by clicking close long. It's not as long as you have close selected, it'll only close positions. So if you're in a short and you're trying to, you accidentally click short and you want to, and you're trying to essentially close a long, it won't do anything essentially because you don't have anything allocated. Now, this is important for things like hedging. And if you want to take profits without actually having to set take profits, let's say you're scalping, you're going really quick. Hey, we just made some nice gains. Okay, I want to close out a quarter of my position. Bang, lock it in as essentially winning or as profit, right? So that's an important thing to remember as far as like open and closing. When you're looking at trailing stops, the big thing here, especially on closes, I would always recommend that you have a position already before you mess with this stuff. So you hit close, and you want to be able to close longs, right? So the middle long. You hit the trigger price for the trailing stop. So maybe let's say at 26,165, I want it to enter a trailing stop. And what's that stop loss going to be? So if I look at the current structure of it, let's say that's my entry from where I want it to, what is it, 2165, I'll call it from there, down back to my entry, so 0.54, we'll call it 0.75. So if I want to move it, my trailing stop entered, I can then say what my callback rate is, what percentage. Now you can manually adjust that, or you can type it in. Here I know that, well, I want it to trigger a trailing stop loss if it goes there, because then I'm locking in profit. So let's say I put my trailing stop in at 0.74, right? And then the amount in BTC needs to be in relation to the overall allocation in your trade. And then from here, what did I have? 0.001, right? So at 26,165, I want the close that amount of my trade, which is the entirety of it, right? Because that's the total closable amount of my trade size. And I want to close it on a trailing stop. So then I enter that as a closing long. So there you go. Once price hits that point, I'll have a trailing stop hit, and that will then bring, it'll follow the current price by 0.75%. You can also manually change this thing, so you can click and drag, your where you want your trigger price. It'll give you a bunch of prompts if you never used it before. Like I said, it's a new account. I'm just using it as a test. But overall, that's a pretty easy way if you want to set, say, limit orders for take profits and stuff like that. It's a great way to use it. So we've done that. We've done some trailing stops. Another interesting one is a post only. So this is actually something very, very important for guys who are using large position sizes. So as an example, let's say I want to take a larger position and I want to limit in locally. Let's say I want to limit in at if we gain 26.2. Now the problem is if I were to typically type in 26.2, and then I would say, I don't know, call it a 6K position or something like that. And if I enter that now, since it's above, right, that price there is above what I would want to get in at, it would enter me now. It would market me into a position right away. And the reason for that is that because its machine is saying, oh, well, I can get you in at a better price for a long now, but you'll still pay 3 times the fees. Now, what you can do with this is if you want to set it at very close to the current price and then have it on post only, right? And you start, and you have it on open, obviously, and you hit longs, what you'll end up doing, or shorts, depending on where you want it to post, if the price is below that price, it will instantly kill the order. So that means that it will not go, if it goes higher, if it's still below the current price that you want to get in at, it won't force you to market enter. So you can use this if you're trying to look for a gain this to go there type thing, especially if you have larger position sizes and you don't want to pay those 3-time maker fees. You can then click that buy long. And what that allows you to do is to keep clicking it. It'll kill the order until you finally get a fill in the book. So anything that comes back and tests your level, you're now essentially going to be getting in at a limit order at the current price or at the price that you type in here. So it's an interesting one. It's an interesting test to use. And from that, we'll also look at trigger orders. Trigger orders are very simple. It means that only execute a price enter of this, or maybe if I don't want to market order, can I do? Yeah, I can only do market orders. So it basically means that this order execution won't happen until it reaches this price. So let's say I want to take a new trade of a long. I want to add to my current long, right? If it goes to 26,234. And then what I want to, that's the execution price. And then my market order, essentially if price goes there, I can set it as the same thing, or I can set it as something below it or above it. It doesn't really matter. If it's a market order, it'll still get you in at whatever the price is. So if you're trying to catch, essentially, I want a long to add to a position, or if I want to short and close out previous stuff, which, you could hit really quickly, just smash the reversal button. But if you're trying to set it up and automate it, it really helps to essentially say, don't do an order that I want, set the order of whatever until it reaches that price. And that essentially sets a limit to say that it's the same thing on most exchanges where they'll, instead of the word trigger order, they will use the term stop order. It's the same exact thing. And then with, the TPs and SLs, that's pretty basic stuff. You can only set one initially when you currently take a trade. What I recommend people to do is don't worry about the take profit as much as you do if you're setting a larger position, that you start the position and you create a limit order that has a built-in stop loss. So, and with that, a couple things just around using that stuff. I'll talk about it really quick. I found a really nice calculator. It's called the Bitcoin Lot Calculator, Cashback Forex or whatever. Pretty easy stuff. So, but let's say if I just use an account balance of that, what you're essentially looking at with some of this, risk structure you're trying to do, we're talking about risk of the size and position sizing of our positions, right? What we want to use when we're looking at this stuff is the correct amount of leverage to maximize our positions. So you can use calculators like this in order to calculate what type of leverage you want to use. And the biggest thing being is that when you're calculating a position for a risk reward ratio, you want to make sure that whatever your leverage you're using, that you're, even if you're using 3-to-1 as a minimum, which that's the golden rule that we live by, right? 3-to-1 risk reward ratio, 4-to-1 is usually better. That's usually what I focus on. But in general, having that risk reward, then looking at where your stop loss is. If I'm allocating in my trade, say 2% of the total quantity of my assets isolated, that means that's the total thing at risk. I can then look at where the liquidation price is, right? Let's say I'm on 10x, way, way, way down below me. So for the lower time frame trade that I'm in, I'm definitely using too low of leverage because I'm not maximizing the use of the value of my position. So what you essentially want to have happen is that wherever your stop loss is, you want to make sure that it's above your liquidation price. Because if your liquidation price is above your stop loss, you're not maximizing the use of your capital. And we've talked about this a lot on some of the different streams, and I've talked about it just in general on the firesides, is that liquidation levels from exchanges, it's not perfect. It's not even good. If price, let's say if I got in, and I was using 100x leverage at 25,641, if price were to move, 0.7, that 100x would get liquidated. Now you would think if you're at 100x, let's say with whatever amount of money, I would get a full 1%. The problem is that the exchange also has to make sure it's protecting its capital because it's loaning you, or it's essentially giving you access to 100 times your initial margin to take a trade of a value that's 100 times higher than your initial margin. So that's what you're talking about. Now, if you think about that as far as percentages, what's the difference between 0.7 and 0.1? That's a 30% difference. You're getting screwed out of 30% of liquidity because you're at a very, very high leverage. So that's an example of one major reason why you don't want to use your liquidation level as your stop loss. I've seen a lot of guys try and do that and try to justify it. You're essentially giving away free money to exchanges that have countless billions, most of them. So that's the big thing with that, making sure that your margin rates are decent, making sure that that's never close to 100, making sure that your stop loss is above whatever your liquidation price is, regardless of the size of your trade. And that's just something you can do. And then using some of the different tools are cool. We set the trailing take profit thing. It's very quick to just close open orders. And if you want to close orders such as, flash closing, it's essentially you're getting out immediately. That's as quickly as humanly possible. But just hit close. That'll close the order, market close it. With stop losses also, you're always marketing out. Like you're not trying to limit out of a stop loss because you can get skipped. And when you see things like, wait, I don't understand, the price didn't go this high or this low and I got skipped on an order, it's because the mark price is different from the index price. And that's the biggest thing overall. So yeah, I'll kind of open it up a little bit from there as far as questions or any how-tos or anything like that. We'll go through whatever you guys have. Egil, you got any questions, or are you just such a change guy? Oh, no worries. Yeah, like I said, if you guys got any questions, just type them in the chat real quick, and we'll go through a few things. with the exchange stuff. And the biggest thing here is like there are ways to get used to an exchange. Like this is actually pretty cool that they have a futures demo. So essentially, you're paper trading, and if you're using a new exchange, a lot of the good exchanges will allow you to paper trade to get used to understanding the orders and the different things like that. And it's a learning curve for a lot of exchanges. Most of them are now the same, so it's around about the same exact thing, regardless of what you're trading. So from that, I basically just recommend spending time with it and testing out what works and what doesn't. But one of the biggest things that helps as far as like calculating your risk, yeah. Oh, mm, oh, okay. He's getting his providers giving him video and voice call limitations. I'm sorry to hear that. That's all right. This is why we record stuff. But oh, it's terrible. I can only imagine. But overall, with some of the different exchange functions, yeah, you can do stuff like looking at bots. There's future grid box, martingales. Anything that says martingale strategy, walk away. That's essentially, if you've ever looked at what martingale is, it's a statistically fallible system that people use to play games of gambling, like roulette, as an example. They'll just keep betting on red and they'll increase the size of their bets until, essentially trading with higher positions, even in losing positions, to cover previous ones to overexpose themselves. So I would not recommend any of that stuff. And with these type of bots, we've had the long courses from Bing to set up automated trading from some of the signals and stuff that you can output to things like Bitget. This is the one that we've done for a lot of the different bot trading stuff, and they've worked very, very well. It's really quick execution, so we're going to keep working on that since most of botting essentially is going to be taking over. Uh, it's just a matter of time. So I think the biggest thing here, a lot of people, since they're trading on lower time frames as well, is that you got to respect the fact that the price can move very differently from what you see on TradingView. If you're on a different chart, TradingView is pretty good at getting the current stuff correct. So if you're on Bitget perpetual futures, the Bitget perpetual futures on TradingView is still pretty solid. They're still giving you the same accurate numbers, and that's where you still plan most of your trade. But you can still do it here, right? So you can get all of your data from there. You can then plan your trade and just transfer it so you have it all in one user interface. It's definitely something to play out and test with. And like I said, with every exchange, when you're taking positions, the first thing I always look at is, am I in an isolated or am I in cross? I never recommend cross to anyone. Cross is how most people get wrecked because now your entire account is at risk with a certain position, and it could just go against you really, really badly. We saw with like Binance.us how crazy the liquidity slides were because they've had liquidity problems to provide liquidity for your Binance US users. They essentially just getting absolutely massive accounts liquidated because they couldn't have enough liquidity to provide to keep people in trades successfully. So that's pretty much it for the exchange usage. I'll probably do some more of these just to give people a general understanding of how some of these exchanges work. Some of the functions that are really awesome, like trailing stop. That way you don't have to keep moving your stop loss up. You're in a profitable position. You want to stay in that profitable position as much as you can. At the same time, not getting lost on those levels. I think that's really important. And then also reading into how much the different orders cost, maker and taker. And the simplest way to explain maker and taker is if you're marketing in and out of positions, you are paying 3 times the trading fees, and that becomes massive, especially on over time or on larger position sizing. So just remember that it's a big deal. But I think that's about it. Unless there's any questions in the chat, real quick, I think I'll kind of yeah. Yeah, there's some advantages to it as far as like providing margins. The problem with that I have with cross is that a lot of people get will do the same thing. They might have a couple really good days and build some really big positions and then have it on cross. And if it goes against you, you can actually get cascading liquidations on your account, because one liquidation will drop your margin of your account below certain levels and then liquidate the next position of the next position. And I've seen that happen before. Yeah, so you're essentially taking like a giant, like a fully allocated, like you're essentially just doing. Yeah, yeah, exactly. And yeah, and a big thing is too. It's the maker and taker fees when you look at things like if you're trading high amounts, like let's say your monthly volume is over 100 mil, which surprisingly is not that hard to do at all. You'll get higher level status, and you get to pay less fees if you maintain that, or if you lock in an exchange token, which I usually don't recommend. But you can build up volume in order to unlock cheaper fees pretty easily. Because if you're paying high fees, especially with funding rates the way they are, an easy way to calculate this is that if this is every 8-hour period, like imagine every 8-hour period you're paying, 0.012, and then take that and multiply that by 365 days, and very often funding rates will end up costing people, if they have imagine a position open for a year, you'll end up paying a 10% funding rate regardless of what the market's doing price wise. So there's a lot to be said with that generally. There's it's a big deal to kind of like look at those calculations and see how that works. If you want to do risk calculation stuff, I do recommend using something like this. I think it's a pretty good, easy way to calculate a risk, and how much leverage you can essentially use depending on your trade plan, which is actually quite nice. So I think even here, I could have had, like, if I invert that 0.118, I could have like 90 or 89% or 88%, 88x liquidity, or what is it, leverage. Let me just test that to see if that's the correct. Let me close this sucker, and let's play some games real quick. Yeah, oh, that's right. Because otherwise I was trying to limit close. Thank you. All right, I'm on cross. I'll put it back on isolated, and let's say I want to short with. Let's test 75. Confirm, and we'll do 3%. I'll mark it down. 3% sell. Why is it only? Okay, I got it. Only long positions allowed? I don't know. That's very strange. That is one of the strangest things I've ever seen. I'm not having a connection issue, am I? Oh, okay. Hold on. There you go. See, I had the long TP SL on instead. Yeah, exactly. So there you go. So looking at it here, let's say if I just look at it from a short position perspective. All right, where's my liquidation price? 26,240. Short position. With an entry of okay. So that, as an example, that's my liquidation price. 26,240. way too tight. I'd have to keep that probably a little bit lower, so 26,167. And you can use that, like I said, I'm on 74. I probably could have gone all the way up to 88 in order to get that liquidation level, and still have maintain the risk reward of something like 3 or higher. Essentially, test the lows, right? And then I'd have to put my stop loss in as that, essentially. So then my stop loss would be 26,167. It's below my liquidation price because I'm in a short. So when you're using stuff like this, look at the trade size. It's going to be the inverse of that in leverage. So here we would be somewhere around 87%, 88. And realistically, you wouldn't want to be that close to your stop loss being a liquidation. So food for thought. It's good ways to use it, but I'm going to yeah, exactly. I'm just gonna close that because you don't ever take those high leverage trades in the current market conditions unless you're low time frame just smashing in and out. But again, the market price and liquidation price are different. As an example, it's just a good way to maximize the position size, because if you're risking 2% of your account, which you can just use on a slider bar here, that's the maximum. That's the percent quantity of your total assets that you can use in that position. So if you're using 2% as a risk, you then calculate that out where you would want to open your position at, and then where essentially you could have your stop loss would be at, and then that'll tell you how much. The inverse of that, it tells you in leverage what your essential sizing is, and that's how you set. That's the easiest way to calculate how much leverage you should use to maximize your trade sizing based on the risk, if that makes sense. Yeah, that's just one that I found that's actually pretty decent. Cashback Forex one. But I think that's it. I think we've hit all the points. The big thing here is very simple: is make sure you're testing. If you're new to using exchanges, use the paper trading, whatever it is, to get used to the function of using an exchange. So that'll help you entirely with understanding order process, how the different exchange functions work, and yeah, don't make stupid mistakes like me leaving this ticked and trying to enter a position, but I can't because I don't have any information entered in to take profits or stop loss. Look, it'll reject the order immediately, right? Those little things like that can be very dangerous, and yeah, it's definitely something that you want to test and get used to using before when you're trying a new exchange. Mhm. No, that's exactly a good point. Yeah, I mean, yeah, exactly, and that's exactly how we talk about stuff. It's use paper trading to use the functionalities of an exchange, but if you're actually trading to learn and make money, just use the lowest amount of exposure possible with the lowest amount of leverage to understand the psychology. And as you improve, you increase that. Um, that's the best way over time, because it trains you to take profit based off of your positions. It trains you to not care about wins or losses. And then as your ability grows, you have now trained your brain not to have an emotional reaction to taking profit or losing, essentially, or losing money in a trade. So I think that's all good stuff, sir. Well, I think that's it. I think we'll go from there and call it for the day. Thanks, Egil, and everybody else. I know there's some weird time zone stuff, so thanks for recording it as usual. And we'll just call it, I guess, understanding your exchange, Bitget as an example, or something like that. Yeah, we'll do the replay, and we'll do it. We'll do a couple more of these as well. Absolutely, and that's how we'll do it more going forward. We'll focus a bit more on the exchange, and then essentially taking plans from TradingView, using the indicators to set trade plans. Either on the exchange or then using stuff to calculate how much leverage is right or wrong for position size to make sure that I'm not being, liquidated immediately and stuff like that. So cool.